Welcome to ETF Hedge, your go-to place for everything exchange-traded funds. I'm your host, Pisani, joined today by Tom Lydon, ETFtrends.com, Alfred Eskandar of Salt Financial. Let's get started with the sell-off rocking Wall Street. Dow down 700 points right now. The S&P having its worst day of the year. Nasdaq's down more than 3%. The trade war is escalating. Technology, consumer discretionary, industrials getting hit the hardest. How exactly can investors hedge against more volatility? Tom, you and I have been down this road before. And the usual game is, let's go with minimum volatility ETFs that are out there. There are several big ones. iShare has a whole suite of them. And mostly you're dealing with names like Visa or McDonald's or Pepsi. I guess the concern I have about saying, let's go to minimum volatility is if there is a global trade war, global earnings and global growth is going to come down. I don't care if Pepsi's not much in China. Pepsi's going to come down too, right? I mean, is there some logical problem with going to minimum volatility?
It will, but the S&P 500 is not the S&P 500 that we knew 10 years ago. Kind of go growth, higher Ps, more technology, more financials. When you look at low volatility ETFs, there's more consumer staples. No matter what the market's doing, people are still going to buy McDonald's, they're still going to buy Pepsi, they're still going to take their trash out.
Right.
Those types of things are always going to be stable, tend to be more value-oriented. Value has underperformed growth in the last 10 years. We continue to talk about that as far as fundamentals in the marketplace and factors in the marketplace. It's all been growth, it's all been momentum, and those are the areas that are getting punished the worst.
Well, Alfred, we know the biggest movers this year, sector-wise, all are cyclical. We saw technologies being big mover, consumer discretionary big mover. They're up 16, 17, 18%. Yeah. Am I being too paranoid by saying if you get a global trade war, I don't care what area of the market you're in, the market is fairly expensive and things have to come down. It's kind of hard to avoid it. You can say certain technology might be hit more, semiconductors might be hit more, but well, when overall expectations come down, the market comes down.
You can't avoid your market exposure. So, unfortunately, days like this are the greatest advertisement for low volatility funds and stocks. And what it's basically meaning is you're not going to get as hurt as far as the market moves down. So there's a little bit of a cushion. Tom picked up on something terrific with the sector rotation and some of the exposure to consumer staples. If I asked you over the last 70 years, you have to pick one sector that's going to outperform everything, nobody would have picked consumer staples. But that's the sector that has outperformed, not technology, not financials.
Well, wait a minute, not this year. You're not seeing no
I'm saying over a much longer period of time, it is the one sector. So if you have exposure to that sector during market, downturns like this, you're going to be cushioned going into, the next period.
So where do we go from here? We were just speaking earlier, Mexico's down 2%, Japan's down 2%, Brazil's down 2%. I think it's a 2% down world here on exactly what I've been saying.
It's all judging risk. So right now, there are a lot of fully invested investors out there that are feeling a little bit nervous.
Yeah.
If you feel it's late cycle in the market, you want to take a little bit off the table, that's fine. On the other hand, if you want to downshift a bit, there's some low volatility ETFs
Well, let's
out there.
put up a few of them. The
Sure.
iShares has got an interesting suite of minimum volatility ones. They've got a U.S. minimum volatility. They have a European minimum volatility. That's the EFA one there in the middle that you're looking at. And they've got an emerging market minimum volatility. You can describe a little bit about how they put these in there, but basically you end up with a lot of utilities and consumer staple names. I don't know if we have, I think we have the U.S. one up. It's iShares, it's Visa, Waste Management, McDonald's, Pepsi. Top 10 holdings are only about 14%, so it's pretty spread out if you want to look at what's in this particular
And the
ETF.
thing that jumps off at me here, it's not just the U.S., Bob, but individual investors are underallocated overseas in developed markets and emerging markets. Look to see if you've missed this emerging market move to play it in a low volatility way. And there's some great low volatility emerging markets.
Well, Pepsi is certainly very active in emerging markets, that's for sure. They're not terribly active in China, though, but they're certainly very active out there.
Yeah, same with McDonald's. That whole thing across the board. If you look at this as an opportunity and you're a long-term investor, have a 10-year horizon, boy, there's some great buys out there.
Yeah, Alfred?
Well, we happen to take a look at minimum volatility a little bit differently. We care more about beta stability, which is, how low volatility the stock is and how long does it stay that way. That's how we construct our low volatility